start with, like I said, the India business has once again emerged as the star performer. You've spoken about, better product mix, lower exports. These have definitely contributed. And in a way, they're also reflective of how demand in India has become even better in the third quarter. So shed some light on that. How has Q3 been in terms of demand and obviously in terms of pricing as well?
Yeah. So a few things happened in Q3. Firstly, we saw the continued recovery of demand in the domestic market. And secondly, we saw the recovery in the demand for the auto sector. And that had a big impact on the product mix. Is the part where we said the product mix got better in Q3. The second part is in Q2, we had exported about 25% of what we produced because the domestic markets were still not strong enough and the international markets were very strong. In Q3, as the domestic markets picked up, we sold more in the domestic market. So the exports came down to about 12%, 11 or 12%, which is pretty close to our long-term average because normally we export about 10, 12% every year. So the mix impact in terms of product mix and the mix impact in terms of geographic mix worked in our favor.
Do you think, Mr. Narendran, that we are anywhere close to steel prices perhaps plateauing from here on?
I think in India, the focus on infrastructure is certainly going to help steel demand. So the steel intensity of growth in India could get higher in the years ahead as India moves more into infrastructure-led growth and fixed asset investment-led growth. Because traditionally, India has been more consumption-led growth than investment-led growth, unlike China and many other countries. So I do expect that over a period of time, the consumption of steel in India will grow faster than the GDP growth rate, as it should in developing countries. Whereas in India, if you look at it, it has been growing at lower than the GDP growth rate. So that's a correction I expect to happen. So I expect steel demand in India to be strong in the medium to long term. Steel prices will be reflective of what happens in international markets, what happens in China, what happens to iron ore and coal prices. And so it will go up and down. But if you really look at the long-term average of steel prices, of course, today's steel prices are higher than the long-term average, but the steel prices 1 year back were lower than the long-term average of steel. So it will settle somewhere in between. It will keep going up and down depending on what's happening in the international markets.
So how do you make yourself self-reliant in those areas then?
So in our kind of business, what is important is to be one of the lowest cost producers of steel. I mean, in these businesses, you have to ride out the down cycle, and that's more important than doing well in the up cycle. And Tata Steel has consistently, the India business has consistently been one of the most profitable steel businesses in the world. Even in the worst of times, we've delivered 20% EBITDA margin in the domestic market. So that's the strength of our domestic business, our fully integrated value chain, our network of distributors, our equity with the customers, our product mix, our brands. So all this allows us to deliver consistently 20% EBITDA margin or above in the India business. And that gives us the strength. So even in a down cycle, even when steel prices, hot rolled coil prices have gone down to $380, Tata Steel in India delivered a 20% EBITDA margin. So that's where the strength comes from. In the up cycle, of course, we will do well. But I think what is more important is how we do in the down cycle.
Right. So apart from the strong cycle, another highlight of the quarter is deleveraging. What aided working capital release, which contributed to deleveraging as well?
So part of it is working capital release. Part of it is because of the profitability improving, the EBITDA is improving. And part of it was because we also paused some of the Capex in India till we rode out the pandemic. So all three factors helped. The working capital release was more evident in Q2 because in Q1, we had produced more than we sold, whereas in Q2, we sold 500,000 tons more than we produced. So that allowed us to release a lot of working capital. We've been very cash focused. We've been tight on running the business, and we've taken out a lot of costs. Even from 2 years back, we started taking out costs because if you remember, even before the pandemic, steel demand had slowed down in India because auto sector was down and some of the construction activities had also slowed down. So we had started taking out costs well before the pandemic, and we continue to do that during the pandemic. And a number of initiatives, particularly on digital technology, etc., have helped us. So when we've responded to the recovery in the economic fortunes, I think we've been able to respond well, and that's demonstrated in the numbers.
Mr. Narendran, you have this stated aim of, cutting your debt by $1 billion annually. You've already done that in this fiscal. So will you up that maybe in the next fiscal? Where will your priorities lie on that front?
Absolutely. It will be a focus point. We had announced this maybe in 2018, and we said $1 billion a year. We did that in that year. We couldn't do that in 2019 because economic conditions were not so great. In 2020, it looked like we would struggle, but we more than made up even for 2019. And that's why the debt has come down very significantly and will continue to come down during this quarter. And next year also, we are committed to deleverage by at least $1 billion. So the $1 billion a year commitment continues. And we will up the ante depending on the market conditions and the cash flows that we can generate from the business.
I want to understand that we are in a low interest regime. The steel cycle as well is strong. So why that controlled Capex on your side?
So that was for last year. We kept it very tight because we were wanting to manage for cash very clearly. And that's why in Q1 of last year, even when we were operating at a much lower capacity utilization than normal, we were cash positive. But given the performance in the last 2 quarters and the expected performance this quarter, we've said that we will start the Capex once again in Kalinganagar, focus on the pellet plant and the cold rolling mill, which are the projects we want to complete first because they help us take out more costs and they also help us in the product mix. And then after these two, continue with the other elements of the Kalinganagar expansion, which is a blast furnace and addition to the steel melt shop. So we will now come back to spending Capex, but of course, without losing a focus on deleveraging.
So you say you have started allocating capital in margin expansionary project. What are the products? What are the timelines?
So in the next 12 to 18 months, we hope that we'll be able to complete both the pellet plant and at least most parts of the cold rolling mill.
So Europe continues to disappoint despite the rally you've seen in steel prices across the globe. Why is the business not being able to reflect better spreads? What's the way ahead? The way like India business has seen an expansion. What is the problem area in Europe?
Yeah. So there are a couple of things. Firstly, if you look at the underlying numbers, there are one-offs last quarter which has made the reported numbers look worse than the underlying numbers. So if you look at it on an underlying basis from Q1 to Q2 to Q3, there has been an improvement of close to about 200 million euros. If I look at it from the Q1 underlying performance to the Q3 underlying performance. Part of it is operational, or the production being more stable and the volumes being up. And part of it is because the spreads have improved. On the spreads, the second point to be noted is in Europe, our tenure of contracts are much longer because there's a greater mix of automotive and packaging in the overall sales mix. And normally they have 1-year kind of contracts. And most of those contracts were due for renewal on the 1st of January. So we've renegotiated a lot of those contracts, obviously reflecting current market prices. So the flow through of better spreads comes into Europe slightly slower than it does into India, which has a much higher share of short-term contracts than Europe has. So you will start seeing the European numbers improve further in Q4. And if the spreads continue this way, we will continue to demonstrate that improved performance. It is a challenging geography. Structurally, there are challenges in Europe, which we're working on. There's a transformation plan ongoing there. I know we've done it many times before. We continue to do that. We are also splitting the business, the UK business and the Dutch business, so that the approach is different in each of the businesses. The focus is there. And we also take out a lot of avoidable costs as we split it and run it very lean. So I think there's a lot going on. It's not yet visible as much as it should be, but we think that we will get better in Europe. May not be as good as India, but we'll certainly get better.
All right, fair. Now, the auditor note on going concern remains in this quarter as well. Funding from the parent is going to be zero or very limited. So what will be the source of sustenance for the Europe business? I mean, will it be able to sustain itself with this improvement we are seeing in steel spreads? And that you never know. Given the fact that the cycle is so ever-changing, it may turn any time.
No, I think, that's a note that the auditors obviously, are required to keep note of these things. But I think fundamentally, the focus is on making sure the business can sustain itself. And that's what we are working on in both these places. Obviously, Tata Steel has backed these businesses for the last 13 years. So it's not as if we want to write a blank check, but certainly, the business has to stand for itself, but it's part of the Tata Steel family. So we will see what needs to be done, but primarily the focus is on making sure the business can stand on its own.
Mr. Narendran, when you say you're looking for a sustainable solution for the EU business, what do you have in mind? Because the SAB deal is the second one to break down in as many years.
See, at a fundamental level, we believe that the European steel industry needs to consolidate to be able to deal with global steel industry and the global issues which are dominating the steel industry. So I think fundamentally we believe that the European steel industry needs to be consolidated. So that was the objective when we had the conversation with Thyssen and tried to do the transaction. After that, when it didn't go through because of Competition Commission concerns, we said we'd focus first on making the business self-sustaining. The SSAB transaction came about because SSAB reached out to us. We were not actively looking for people to do a transaction with. SSAB reached out to us. They thought they saw logic, and hence we had this conversation. It didn't work out for different reasons. But I think fundamentally, step one is to make ourselves self-sustainable. And step two, if there are partners out there who think that there is an interest, we can see. But obviously, we need to find the right partner. It needs to pass the muster of the Competition Commission. It needs to support the strategic logic of consolidation. So all these boxes need to be ticked. We are not actively in any process just now looking for partners. I think we are focused on running the business well and making it self-sustaining.
Budget 2021 was the one that focused on growth and infrastructure. Steel demand is already at a 2-year high in December. Could it improve in FY22 due to the announcements?
Yes, I think firstly, steel demand has to come back to where it was before the pandemic. That itself means that steel demand has to grow by at least 10 to 15%, because steel demand was in the 100 to 105 million ton range, and it's dropped to about 89 million tons this year. Yeah, so that kind of recovery is natural to just come back to where you were before the pandemic. But more importantly, I think the government's focus on infrastructure is positive for the industry. India has always had consumption-led growth, not enough of investment-led growth. And I think this shift is very important. The steel intensity of growth will change. In India, the steel consumption growth has grown at lower than the GDP growth rate for most of the last 10 years, which is very unusual for a developing country. If you look at China, typically the steel consumption grew at 1.2 to 1.5 times the GDP growth rate because it was fixed asset-led investment growth. So we hope that this focus on infrastructure will take the steel consumption growth to higher than the GDP growth rates over the next decade.
What has led to lower steel intensity in the economy that has led to steel growth underperforming GDP in the past few years?
Because it's, like I said, India has been more consumption-led growth. It has not been infrastructure-led growth. It has not been investment-led growth. And I think we are slowly getting there. The focus on infrastructure spending is there. It's continued to increase year on year. And I think, many of the initiatives of the government, particularly in the recent budget in terms of a dedicated financial kind of institution to support the funding, and many other, even the allocation is, I think, 25 to 30% more for capital expenditure in this budget compared to the previous year. All this helps because I think investing in infrastructure, it acts as a force multiplier for the economy. Secondly, it helps us from taking down the costs outside our factory gates, because a lot of our competitiveness gets eroded because of the costs that we incur outside the factory gates. And that's because of the infrastructure deficit and the cost that it takes to move goods from one part of the country to another, or to get goods into the country through the port, so on and so forth. So I think infrastructure spending helps steel demand, hence helps the steel intensity of growth, and also helps us become more competitive.
All right. Now, Capex infra announcements are made every year in the budget, but we see limited participation from the private sector. They too are a big way, a big contributor to the increase in steel demand. So, what do you think needs to be done to spur that?
So I think private sector investment will depend on two things. One is growth in demand, which we are seeing happening, and two is growth in profitability. Because if you don't have profitability, then you will end up with companies who are leveraged and are not able to reduce the leverage, and that's also not healthy, right? So I think with the improvement in demand and the improvement in profitability, private sector capital will come back. Because yes, that has been a problem over the last few years. Most of the investments have been government-led or public sector-led. So I think that will start to shift as we see a post-pandemic recovery and better profitability. And as companies like us and everybody else in capital-intensive industries go through a deleveraging, come back to a healthier balance sheet, then you are in a better position to invest for growth.
All right. The next point, and I think this is a very interesting one to understand, is steel imports. Do you think that it's a problem of the past, that now we are sort of beyond that, because our own steel players as well have hiked capacity quite a bit in the last 3-4 years?
I think this is a problem which will keep coming back to us. It depends on the global macroeconomic conditions and market conditions. So I think what is important is to have a proper and quick response to such situations. I think we've got better at it. Many other countries have been much quicker than India to retaliate to unfairly priced imports. So our problem is more the unfairly priced imports than imports itself. So if you look at the steel industry, 60% of the steel even today into India comes from countries with whom we have an FTA, for which there's zero duty. So Japan and Korea. So there's zero import duty for steel from countries like Japan and Korea. So it's not as if the steel industry is constantly looking for protection. I think steel prices go up and down depending on the international markets. But when it goes down, we just need to watch out for unfair pricing, because typically countries export, let's say if you look at China, they export 10% of the steel.
So, but with the players complaining about shortage of raw material for steel, how do you see that playing out? What needs to be done to secure raw material and raw material prices?
So I think one should look at it not on a monthly basis or quarterly basis, but at least on an annual basis or a multi-year basis, right? So I think India, if you look at it before the pandemic, India produced about 105 million tons of steel, and exported some 7-8 million tons of steel, imported 5-6 million tons of steel. So there is no shortage of availability in India. In the first 2 quarters of the year, steel companies, including us, exported because there was no demand in India. Right? We exported 50% of what we produced in the April-June quarter. We exported 25% of what we produced in July, August, September. Steel prices went up because international prices went up. Iron ore prices went up. Coal prices went up.
So do you think